Thank you for joining me. I'm Juan, lead trader and founder of Prosperity Trade. In this video, I'm going to do a step-by-step guide for my DCF, my free cash flow DCF. It's my initial assessment of a company, and it's what I use to filter out through companies that I want to do due diligence on, or maybe companies that I want to pass up on. You're going to want to watch this video. So if we look here on the screen, this is a simple, basic free cash flow DCF. So first, what is free cash flow? Free cash flow is basically money left over after a company pays their operating expenses and their capital expenditures. So why is free cash flow important to us shareholders? Well, if a company has free cash flow, they can use it to develop new products or make acquisitions, or they can pay down debt, they can pay dividend. So there's a lot of benefit if a company has free cash flow. You want companies with free cash flow. So we mentioned that this is a free cash flow DCF. So what is a DCF? It stands for discounted cash flow. And it's a valuation method, and it's based off of expected future cash flow. And it gives the company an intrinsic value. Okay, so if we look at the first category, WACC, it's basically the average cost of capital, and it's the rate that a company is expected to pay on average to all its security holders to finance its assets. Then we have the perpetual growth, and that historically has been between 2 to 3%, which is the inflation rate. Some people use the historical GDP growth rate, which is 4 to 5%. And if you're a little bit more bearish on a company, or you have less faith on the growth of a company, you would pick a lower growth rate. So after that, we have here the free cash flow. Free cash flow can easily be found on Yahoo Finance. If you go on Yahoo Finance and you go under cash flow, you just scroll all the way to the bottom, and there's a section here for free cash flow. And that goes back all the way to 1989. So after you enter the free cash flow, you have to enter a percentage of growth that you expect their free cash flow to grow. That would take a little bit more research. You can read up on different analysts, what they say, because analysts are always correct. That was a joke. But you can make your own assumptions based off of past growth, based off of what they have coming down, future plans. Do they have projects that are potentially going to bring in more free cash flow? So this takes a little bit more research. I kind of went off of past performance, and I put 7% here initially because their trailing 12 months free cash flow is already above 4 billion. So seems like they're having a good year. I don't think the year after that they'll be able to match it. And I haven't seen anything that Hewlett-Packard is going to do differently that's just going to increase revenue. That may warrant more due diligence. After I do my free cash flow DCF, then maybe my due diligence would prove me wrong, and maybe they have projects or things that I missed. So these are my conservative estimates. Once you do that, it gives you an enterprise value of the company. And all you have to do is enter the financial liabilities, and that can be found on Yahoo Finance, and the cash, and that can also be found in Yahoo Finance. If I find that the company has potential upside, then most of the time I do another DCF, and I'll show that one here. And this one's a little bit more detailed. I enter the revenue for the last 5 years, the cost of revenue for the last 5 years, their expenses, R&D expenses, admin expenses, total expenses, EBITDA, EBIT. I enter all their information basically. Then I get into my estimates, where I have revenue growth percentage estimates, their EBITDA growth revenue, percentage of revenue, their capital expenditure estimates. So I enter all these values, the WACC rate, the growth rate, and then it gives me a DCF of 29.40. Or I'm sorry, this is the current price. It gives me a DCF of 35.52. And what I usually do is take this DCF and the free cash flow DCF and then have them give me an average price. So the average price is $35.40. So now I see this, and based off my assessment, I feel that the company is undervalued. So is every undervalued company worth an investment or worth investing in? Not necessarily. So, but this is the front line. I want to make sure that whatever company I'm investing in, that it's worth $1 and I'm getting it for 50 cents. So after I do this, then this is when I take a deep dive. I'll print out the 10Qs or 10K and the 10Ks. I'll start reading everything they've done for the last 3 years. I usually spend a good 2 weeks on the company. If I can find somebody in investor relation, I usually call them after my analysis and questions that I need answered, like things that I saw in the 10K that I didn't quite understand or weren't as clear or were a bit ambiguous. I'll call them up. Certain lawsuits, if they have certain lawsuits, I may ask questions, and most of the time they're not able to answer, but I like to see their reaction, or if they give me a positive answer. But, I just take my time and do some due diligence. And then after that, I'll invest in the company. So this is the approach that I take when I'm investing, especially for value stocks. You want to make sure you're getting in and you give yourself that room, that wiggle room. So if the price drops, that you're not losing a ton of money because you bought it at such a cheap rate. And one thing to remember, the macro can affect a lot of these companies. So if the price drops due to rumors or due to rumors of inflation or whatever's going on in the government, and you're down quite a bit in your position, if nothing has changed fundamentally about that company, everything you've done after the 2 weeks of research or 1 week of research or however long you take researching the company, then you shouldn't be scared to jump out of your position. You should maybe want to add more because it's even a better value. If you gave an assessment that this company here, like we say, it's worth $35 and it drops to 20 and you got in at 20 and now it drops to 16, you may want to increase your position because your thesis hasn't changed. So this is the approach I take. I hope you enjoyed the video. I hope you learned. Thank you for watching. Please subscribe, comment, and like, and see you on the next video.